business owners have to understand this. Tax planning is different than tax preparation. And it's complementary. And the government,
Yeah.
so they could get what's called a valuation discount since they're not running it. But the government's going to say, hey, that's worth 8 million. And now they got to liquidate the business. And so no tax on car loan interest. Your tax bracket lies to you. Marginal tax rate is your number one KPI. For instance,
What's up, everybody? Welcome to another episode of Cashflow Conversations, where we interview entrepreneurs on their journey from W-2 to 1099 and all of the struggles and fun that we have as an entrepreneur. And today I have a great guest who can help literally every business owner that is listening right now, because every business owner listening has a silent partner, whether you like it or not. The IRS is your partner. So today I have Chris Pecurio, who owns Taxflow, teaching Taxflow. I love the name. My company is called Cashflow Architects. Chris has teaching Taxflow. And Chris is a CPA by trade, but helps basically with high-level tax strategies for high-income earners. So Chris, it's great to have you here, bro.
Matt, thanks for having me back. I appreciate it, and you nailed it. I think we think the same way. One of our 3 laws of tax planning in teaching tax flow and in our private CPA practice is that tax agencies are your involuntary business partner. And what you have to understand is that tax laws are written to either encourage or discourage certain behavior. That behavior could be financial, it could be social, it could be environmental, it could be anything. So if you don't pick your tax, then the government picks it for you. And Matt, you and I are lucky. We live in a gorgeous state that has no state income tax, although we're both from a colder state that had a state income tax
Yeah, man. COVID
originally.
hit and got out of Michigan. Chris is from Michigan as well. I saved almost 5% just by sleeping in Tennessee.
Exactly. And it's a wonderful place. But if you live in Michigan, and then let's say you work in the city of Detroit or you have a business in Detroit, you now have 3 business partners. You got the city of Detroit, you've got the state of Michigan, and you have the Internal Revenue Service. And out of those 3, the Internal Revenue Service is by far the nicest. So, people that work in New York City or California, they have very expensive business partners. And one of the things that you hit on also is that if you're a business owner or a real estate investor, the great thing you have going for you is that you get to pay tax on your net income, not your gross income. So you should be taking advantage of that. Now, it doesn't mean that you should spend $1 just to save 20 cents, right? We don't let the tax tail wag the dog. However, we want to, and my mission is help people legally and ethically reduce the tax they pay in their lifetime. So, but yeah, since we've
Which
spoken.
is great. I talk about it when I teach the cash flow blueprint. There are things we can do that the IRS will incentivize. They do not incentivize saving. To your point, I don't want to spend $1 just to get a temporary deferral. I want a deduction or an elimination of a tax. And there's things we can do with our money that the IRS says, yeah, if you do this, we're going to give you some benefits. They don't do that with savings. People think, business owners will probably have a SEP IRA. You're just postponing a tax bill to a time you can't even calculate the tax. Well, what kind of plan is that?
So we use color-coded diagnoses in our proprietary process, red, green, purple, gold. But you're nailing it. The gold diagnosis, I think everyone should be thinking about is tax-free income and growth. And tax deferral is different than tax-free. Just like tax credits are different than tax deductions. But like you said, I mean, if you frame it like this, and most CPAs are just looking for like a deduction today. And then sometimes if you're in a super high marginal tax rate, if you're in a very high, what we call red diagnosis, it can make sense. But a deduction is better than a deferral. And something could be both. But for instance, let's say you go out and you out for your favorite hamburger. And you go and you have it and you enjoy it. And the waitress or waiter comes back out and says, you know what? I hope you enjoyed that, but don't pay for it today. I'm going to come back. How old are you? Okay. You're like, let's say you're 30 years old. Okay. In 30 years, I'm going to come back and then you're going to pay me for that hamburger, whatever the fair market value of a hamburger is in 30 years. But that's really what tax deferral is, right? We can't even predict how much it is. And Matt, one of the things that and I know we're going to talk about OB3, One Big Beautiful Bill Act. But one of the things people also overlook are hidden taxes. And retired people get hammered with hidden taxes. One, tax on their social security benefits.
Okay, so really quick. So this is what's so interesting. When I defer my tax in an IRA or a SEP IRA or 401k, I'm deferring my federal income tax in Tennessee. And some people could be deferring a state tax. If
Yes,
you move to a state where there's a state tax in retirement, you've just added a new tax. You
correct.
also are almost guaranteed to add a social security tax. Then there's the IRMA tax. So you've deferred one and added on more by kicking the can down the road.
Right. Irma. Irma used to be a good thing. Back Utica, Michigan, Irma's frozen custard, probably the best frozen custard you're going to get in the Detroit area. So growing up, Irma's was like a reward for if we won our baseball game. And now Irma's a bad thing. And it can be very, very expensive for married couples. Because think about it, and this is, I'm working with, and our firm is working with people that are early retirees that that we've got some time. They haven't hit required minimum distribution age yet. However, they know that it's like when man, when we're driving to Florida and we know we got to go through Atlanta, and it's like, oh, there's just no way around this roadblock. I've got Waze, I got maps, I got every GPS on, and they're all telling me I'm shafted. I'm going through Atlanta and it's going to be a disaster. So you've got this roadblock, meaning you're going to pay tax on that income, or you're going to take tax on those distributions. And when you start taking Medicare, your Medicare premiums are going to be higher, hidden tax, than, and for 99% of people, there's no deduction for that because they're getting phased out of it. Then if you didn't have that income.
Then your neighbor who gets it for much less because they're not showing the same amount of income, right? Like,
Yeah.
and this is what I hate about traditional CPAs. I call them historians. They look backwards at your books. They don't do tax strategy moving forward. And they're triggering an unnecessary tax that doesn't have to exist by not hitting the problem head on. And what I think, use harsh language here, is lying to the consumer, saying we're going to put you in a lower tax bracket. Well, the only way to be in a lower tax bracket is to live on less income. And I don't know any entrepreneurs that their goal
Hmm.
is to live on less when they get older.
Right. So you've got that's why we talk about legally and ethically reducing the tax you pay in your lifetime, not in 2026 or 2025. Again, retirement plan contributions can be there. There's some positives to them. However, there's some traps, right? And so when you get these clients that the old school way of thinking, you could even go to the rich dad, poor dad school of thought of like, okay, I want my house paid off, and I have, let's take someone who's done really well. They're like in their early 60s. Let's say they're 60 years old. They've got $5 million in their retirement accounts and they paid their house off. Well, the challenge, well, first of all, congratulations, good for you. But the challenge is you have required minimum distributions coming up on that $5 million, and it's coming in like, let's say 12 years. So that money could double again. And now, 4% of your RMDs to be 200, 300, $400,000, which is all taxable. Now, 85% of your social security is going to be taxable, and you're going to pay the most amount of IRMA, the income based Medicare premium adjustment. So
Yeah.
it's
This
tough,
is a
man.
this is a rabbit hole, man. But I don't enjoy working with 65, 70, 75-year olds because they've postponed this problem so long. And to realize that the solution is something they've avoided for 20 years is a hard realization for them to have. So this podcast really is geared towards entrepreneurs in their 40s and 50s. How
Absolutely.
can we reduce tax for life and most importantly, as someone who's likes control, how do I control this? Not everything needs to be in the hands of Wall Street, the Pirates of Manhattan.
Right.
Did you ever read that book? You ever heard of that? Pirates of
I
Manhattan?
haven't read it yet, but I'm going to put it, I'm actually writing it down. So thank you.
It's a kind of a difficult read. He's not an author by trade, but it's a great story. And it just talks about Wall Street and
Hmm.
the insider trading and all of the stuff. We think we're in control. I saw another video yesterday. 88% of the money in Wall Street is owned by the top 1%. You don't think they're pulling strings?
Right. Well, let's talk about, so yeah, so like we've got for entrepreneurs, and we talk about this in our community, the Teaching Tax Flow community. Ideas are cheap and implementation is valuable. So what I don't like is when people go on social media, CPAs or tax strategists, and tell you that you should do all this stuff that it doesn't pertain to you. But I will say this, for someone like You can come up with any fact pattern. Come up with one that's, hey, I've got a roofing business and I'm a sole proprietor. I've scaled up and I'm thinking about selling my business in the next in 5 to 8 years. I'm in my early 40s. The tax code's written with the One Big Beautiful Bill Act, the expansion of something called QSBS. Now, I'm going to try not to use them in a lot of acronyms, but that stands for Qualified Small Business Stock, or you might hear Section 1202 stock. So if you're a C corp and you are in a qualifying business and you own the stock for at least 5 years and you're a founder, you could exclude well over $10 million. I think it's going to be $15 million of capital gain from the sale of that
Unbelievable,
stock.
dude.
Pardon?
That's unbelievable.
It is. So for someone like that, kind of like you're talking about, the planning has to start now because it might be better for them to be, let's say, a single member LLC taxed as a disregarded entity or an S corp. Again, way too many people jump into S corps before they should. But at some point, we might want to make them into a C corp 5 to 7 years before exit. Understand we might pay a little bit of corporate tax, but we're getting a huge capital gain exclusion out of the way. Look at like if we talk. Let's talk about tax laws are written to encourage and discourage certain behavior. Primary home ownership, right? The golden egg, pretty much.
American dream.
Yeah, and if you're married and you qualify, you lived in your house 2 out of the last 5 years, you fully qualify. There's some rules if you rent it out and stuff, but Section 121 exclusion, so you could exclude up to $500,000 tax free from the sale of a primary residence, which
You know
is
what? I'm going to second that because we just sold our house and we made a $500,000 tax free.
yeah, that's amazing. And it's like, wow, so that's powerful. If you say, a lot of people talk about the Augusta rule and all this other jazz, like so, but if you're self-employed and you could legitimately rent your home out for special events and stuff, that's tax-free income. Or even if you're a homeowner, you're not self-employed. I know this is geared towards business owners, and you want to rent your house out for up to 2 weeks a year, tax-free, you can. So for like in the Nashville area, we might say, you know what? I'm sick of the humid weather in July. I'm going to rent my house out to a bunch of people going to the CMA Fest. I don't care if they trounce around it. But for my wife and I and our family, we travel for Thanksgiving week, travel for Christmas week every week. And we've rented our house out many, many times to friends and family when we're out of town, tax free up to 2 weeks a year. We
Beautiful.
wouldn't have strangers in here, but I'm just saying, why not?
Yeah. That's another thing too, is like, I know family members that are like, I don't want strangers in the cottage. It's like, I get it. Then how about you find a way to rent it to a friend? And then all of a sudden you change this liability called a cottage and turn it into an asset that is an LLC. And you can create deductions around that. I think you've heard about me talk about a 401 cottage versus a 401k,
Hmm. Hmm.
short-term rental. The government wants me to do that. They don't care if I put money into a 401k. They say you're going to pay the tax today or 20 years from now, and we get to decide in 20 years what we're going to charge you. That doesn't sound like a deal that's going to favor me.
Right. I mean, you look at so I call the Secure 2.0 Act the Middle Child Act. You've got the Tax Cuts and Jobs Act of 2017. You got OB3. I love Star Wars, so I got to go OB3. It's like Obi-Wan Kenobi and C3PO. If they had a baby, that'd be really disgusting. But I'm just combining the names, right? But you got Secure 2.0 Act. It's like, hey, remember me? And I have a middle child that you may or may not know, and they could be a little bit of a squeaky wheel. Great people, but middle children always are looking for that attention. So Secure 2.0 Act, what's that act telling us? It's telling us later our required minimum distributions. Hey, we're going to increase the amount you can put in retirement. We're going to make it mandatory that people have to go into a 401k now for new 401k plans. In other words, the IRS, the federal government realizes, hey, we make out better when people put money into these retirement accounts because usually they're in a lower marginal tax rate and everyone thinks, well, I'm not going to have much tax to pay when I'm retired. It's the exact opposite. And then it grows tax deferred. So just be aware of that when you're planning,
You know what's funny though? I'm going to bash the advising industry. The financial advisors of the world that advertise on Facebook and all over the place that people are under the assumption that they need to use get an incentive themselves to manage pre-tax dollars.
Mhm.
There's a reason your advisor likes your 401k more than you do. It's because they're charging you fees on money that has to go to the IRS eventually. And if you don't pay it, your surviving spouse will pay it. And if they don't pay it, then your kids are going to pay it, and they have to, on top of their own income.
Hmm.
But the advisor charges a fee on the gross amount, the total amount, which the consumer will never actually realize.
Well, yeah, I mean, it's it's not liquid unless you pay a 10% penalty. So, but what's interesting now with like there are it's just interesting with the One Big Beautiful Bill Act, and we're trying to read between the lines and say, okay, what is this telling me to do? What are
So
the
let's talk about the big, beautiful bill, because I think people have heard about the term. They know it's Trump did something. Sum it up for us for the business owners.
So for business owners, you have the bill is in general pro business owner, right? It brought back the concept of what we call bonus depreciation. So bonus depreciation is that accelerated first year deduction when you place an asset into service. Caveat: buying a vehicle is not a tax strategy. If I had $1 every time someone thought that, no. So if you need a new vehicle, get one, great, but don't.
Can I depreciate my Lamborghini?
You could I don't know if it's eligible for bonus depreciation, but maybe it is. I don't know how heavy it is.
So the big, beautiful bill, though, is geared towards business owners. The bonus depreciation
Absolutely.
came back.
Bonus depreciation, that's gonna be your tractors, that's gonna be your equipment, that's gonna be, I mean, even if whatever machinery and equipment you purchase, most likely it's gonna be eligible for first year deduction. Does it mean you should take it as a first year deduction every time? Absolutely not. Bonus depreciation is automatic, but you can elect out of it. Who else did it help? Real estate investors. Why? Because with 100% bonus depreciation, now you get the cost segregation study, which you could front load the deduction. Or business owners. I just met with a potential client that's in the medical field that purchased an office building to operate their medical practice out of. Oh, great. Now you've got some opportunity to cost segregate that and create some tax-free rental income. You got, we have to pay fair market value rent and all that kind of stuff. But I'm just saying, that OB3 with bonus depreciation really helped business owners. Also, Section 179 deduction, which is, I call it the cousin of bonus depreciation. So, bonus depreciation you get, but you have to elect out of if you don't want it, and you can elect out of it on an asset class by class basis. Section 179, you have to elect into. So utilize. Now, business owners, you've got like this Play-Doh, we're not, I'm going to age myself, but I guess if you're watching this, you're probably in my age group or a little younger. We're not putting on our Sunday paper and looking at the comics anymore. We got this Play-Doh that we can mold and say, let's match this immediate depreciation deduction with our highest earning years and utilize it. So yeah, very much pro business owner on those two fronts.
I have a question about that. So if I were farmers, I have a number of farmer clients. They can bonus depreciate a tractor.
Mhm.
How does the recapture work if they sell it for less than they paid?
Yeah, so that's where it gets tricky. If you sell an asset or trade it in at any time, you will, or if let's say you used it 95% for business and now you're using it 40% for business, you could be subject to depreciation recapture, meaning, and that's one of the, hey, you're working on all three of our teaching tax flow laws: cash flow versus tax flow. So let me paint a picture as a business owner, and this is why I say buying a vehicle is not a strategy. Let's say that at the end of the year you scrolled around TikTok and you saw someone much more attractive than me telling you to buy a vehicle. You buy a $100,000 Mac Daddy SUV,
G wagon.
the G wagon. Now, of course, your spouse never drops the kids off at school or takes them to soccer practice or anything with this. This is 100% bonus, 100% business, of course, right? So
I've been in that kids line at school. Yeah, I've seen some G wagons.
there are a lot of them, and so let's say you bought it for 100,000, but you put down 20 grand, so you're out of pocket 20,000 of cash. You have an $80,000 note that you're going to pay for the next 5 years, and you take 100% bonus depreciation immediately on that G wagon. 2 years down the road, mama gets sick of her G Wagon or whatever and say, hey, I'm going to trade this in. You go to the dealership, you're like, yeah, I can trade this in for 60 grand. And I just so happen to owe 60 grand. This is a great deal. You trade it in for $60,000. They pay off your loan for 60. How much cash do you have? None. How much taxable income do you have? 60,000, right? Because you already deducted the entire amount.
So it's 60, not the 80.
Right. It's whatever the depreciation was taken. So yeah, it'd be $60,000 recapture because that's what you traded it in for. So
So not the 80 of the original. So like if I bought 100,000, put 20 down, there's $80,000. But if I trade it in for less, I owe tax on the lesser amount.
Right. So that's cash flow versus tax flow. So if you paid cash for the G Wagon or you had a note, it doesn't matter on the deduction side. If the dealership gives you $60,000 when you trade it
That's
in,
income.
if you get the 60 grand of cash, you're paying, yeah, you're at least you have cash, but you're paying tax on the depreciation rate capture. But the dangerous part is when you trade it in, you have no cash and a $60,000 taxable event.
I mean, one could argue you took $100,000,
For sure.
you're paying tax on 60, but I don't think people realize that the tax is due on the sale.
Business
How often
owners,
is
a
that
lot
missed,
of
do you
them,
think, when people sell a car that they depreciated? Like, how often do you think it's missed to recapture that?
I mean,
I
if
mean, if
it's
you
a,
get audited, they're gonna find that right away, wouldn't they?
yeah, yeah, they're going to find it. And I mean, it's pretty easy to find because there's a special line. So, kind of like we said, tax agencies are your involuntary business partner. Vehicles and equipment, there are special lines and special questions, especially for vehicles on what's called a Form 4562, identifying, where, questions. And here's where I think the IRS is going to be investing a significant amount of money in their own AI and their own software to say, hey, you know how easy it would be for them to run a report and say, they're going to sample it, grab 1,000 tax returns of business owners that had a vehicle on their tax return that the next year it's gone, but it didn't get sold. It just mysteriously went away. And they'll probably, it's easy. And then they're just going to send you a letter, right? They're not, to me, the IRS isn't going to audit people like they used to before. It's going to be in person. It's going to be a lot of correspondence audits. And then you just went down a rabbit hole. And if you get a correspondence audit and it's kind of like getting pulled over for going for not wearing your seatbelt. If the police officer comes to, thank gosh, I haven't been pulled over in a long time. But let's say the seat, they come to your car and they're like, you don't have a seatbelt on, but you roll the window down and it smells like drugs and you've got beer cans laying around and you got paraphernalia. Now you've opened yourself up and then they ask for your registration and you can't find it. Now you got bigger problems. So the point is, I don't know why I went down this rabbit, but just because you're talking about the vehicle, that definitely make sure that you show that the vehicle got traded in. Now, here's a good thing in today's environment: if you trade the vehicle in and you buy another one, you probably get the bonus appreciation from the new one's probably going to offset the trade in of the old one. But it's almost like retire, kicking the can down the road again on this
Yeah.
equipment.
Yeah. All right. You were gonna go back into, I think, 179, or that was 179.
So yeah, 179 is like bonus, so very much pro business owner. Couple other things that are pro business owner. So, man, I know you have younger kids. Mine are a little older, right? If your child, if you have a teenager and their bedtime's 10 o'clock, and then they get a year older and they want an extended bedtime, and you say, actually, no, it's going to be 9 o'clock now. Sorry, it's going down. You're going to be met with, or anyone that went away to college, when you went back home, oh, you mean I can't stay up till 4 in the morning, 3 in the morning and go to Canada or go do all crazy stuff? No, you got to live by these rules. So the point is, what the One Big Beautiful Bill Act did was it allowed those children to have later bedtimes, meaning this, as a business owner, a lot of the pro business provisions in the Tax Cuts and Jobs Act were actually going to go away. And many people weren't aware of it. So OB3 brought them back. So the qualified business income deduction, or Section 199A, a huge gift to business owners. That's up to a 20% deduction based on your business income on your personal return. So that's back and very
That's great.
helpful.
I take advantage of that, right? Personally.
Absolutely. You should be. And
Yeah.
and so that's back. And that's not just based on your income. It could be based on your assets. It could be based on your wages that you pay to people. So that's huge. Another major one for business owners, which kind of sprinkles into individuals, the SALT tax deduction got raised. Oh, what's that? No, it's not the stuff you put on your food. State and local income tax. One of the compromises of OB3 across the aisle was for those higher tax states to get some type of benefit for the state tax deduction. For a married filing joint, that's up to a $40,000 SALT tax deduction as an itemized deduction. So if you're a business owner and you have to pay a state income tax, a lot of times you were not getting that deduction at all. It was getting
That's
phased out.
crazy. Let's talk about it. Like, so I send 20 grand to the state of Michigan.
Mhm.
I can't deduct the 20 grand off my income for the federal tax.
It was capped at 10,000 under the Tax Cuts and Jobs Act. Now that cap is $40,000.
Beautiful.
There are phase outs on based on your income, and that's the world I live in a lot. I have to manage the number one KPI for people.
I wonder if
Taxpayer.
people in California even realize that that happened. You know what I mean? I mean, because that's who gets hit the hardest. The state
Yeah,
income tax in California is 13% for the high income earners.
they're going to
They just got an
benefit.
extra $30,000 deduction
They're going to benefit the most from the
from
bigger
that
salt tax.
orange man bad guy too.
Yeah, I mean, they're gonna benefit the most. So they could be getting phased out based on their income. So for business owners watching and listening, if you are talking to your tax professional and they tell you your SALT tax deduction was limited because of a phase out, one of the things you could consider doing if you are what's called a pass-through entity, meaning a multi-member LLC or an S corp, is to make, and I hate to get too technical here, but make a PTET election. E3 said gave a PTET their stamp of approval. That means pass-through entity tax. But man, let me paint this picture. Prior to them moving to Franklin, Tennessee, like everyone else, making $1 million a year, and let's say they are self-employed, they're probably paying, as you mentioned, $100,000 of California tax. They're getting no deduction for this. They're getting a $10,000 deduction for this because now they're phased out of the SALT tax. We can make an election for the business to pay the tax on behalf of the taxpayer, that $100,000 tax, and take a federal tax deduction for that. That's a $30,000 tax planning benefit. If they're self-employed, they can't do that. That's the PTET. So great. How can we do this? Well, one, we might make an S corp election, or two, maybe they should consider putting their spouse on the business. Maybe they're a 1% owner and now they're a partnership. And now they could do the PTET because they're what's called a pass-through entity. So this is what we're talking about planning. Now, what happens sometimes is you get people that are making $5,000 a year. They hear something like this and they say, "Oh, I should do an S corp. I should do that." No, it doesn't pertain to you. The juice has to be worth the squeeze. But that's what one big beautiful bill act did for business owners is it rubber stamped the PTET pass-through entity tax election, and it gave us a bigger SALT tax deduction as well. Just a couple more
Interesting.
things.
So kind of a side note, I saw, the Super Bowl
Mhm.
was this past weekend, and the quarterback for Seattle, they were talking about how he got paid like $188,000, but because it was another day of playing in California, California has what's called a jock tax,
Mhm.
and it can pierce your income from other states.
Mhm.
So he ended up paying. He's gonna owe like $250,000 in taxes, and he
Mhm.
only made 188. It cost him money to play in the Super Bowl. And so the NFL's talking about how they're never going to have a Super Bowl in California again.
I can't see them doing it. It doesn't make sense. And we know here in Nashville, I think we're going to get a Super Bowl. You look at Florida, Texas, right? So each state has professional athletes and entertainers. A lot of times we run into this situation because especially the NFL's the toughest because they're allocating your days played, which aren't that many, with your total income. If you're an MLB player and you play 162 games plus the spring training and playoffs, it's not going to affect you too much. But yeah, that's a dagger. So I don't anticipate them going back to California. It's
No, dude.
or
And
California needs to or negotiate some type of amnesty or some type of special tax-free window for that special event, which they could if they wanted.
they could try. Good
But
luck.
but yeah, California is not going to do it, and that's where
But at least they spend their money well. The state of California. That monorail thing that they made, that's going well.
what
I
a
think they're
mess.
$1 billion in now.
So yeah, you're looking at that. That's a big challenge for like professional athletes, and what'll happen is most athletes and musicians and what entertainers that have a lot of endorsement deals are going to establish residency in a non-tax state. That way, at least the endorsement money is going to be sourced to that state. So
Yeah. Yeah. That's, dude, my entire street, we live in the same beautiful little neighborhood. The entire street is California, Chicago, California, Chicago, Michigan, California, Michigan, Chicago, California,
mhm,
Michigan, Chicago. It's all the high tax areas. People are voting with
absolutely.
their checkbooks and where they sleep at night.
So residency planning is important, not necessarily a one big beautiful bill act thing, but yeah, absolutely residency planning. So yeah, so for business owners, you've got options.
What else is in the big beautiful bill that isn't talked about enough.
Oh, man, so the salt tax deduction's huge. I
That's
think
huge.
the estate tax getting extended, or getting increased is big.
Yeah, let's talk about that.
Yeah, so
What
you
what was it and what is it now?
oh gosh, I think, exact numbers, I think it was about $13 million, and now in 2026, I believe it's $15 million per individual. I think
Individual.
it was like 13.92. I can't remember. About 2 months ago, I was teaching some classes and I had it memorized, but, I'm not that smart anymore, getting old.
But it went up. So married is around 30 million now, and so that's much higher.
Absolutely, and it got permanent, right? Because with the tax, if OB3 didn't get passed, we're gonna go back down to, like, 5 million. And the other thing to consider is, and
That's
this
crazy, dude. $5 million. So how does the estate tax work? So everybody listening understands. Anything above $5 million at death would be taxed at a 40% tax rate, correct?
yes.
So what ends up happening is $5 million is not a massive net worth. There's a lot of people that are worth that. The millionaire next door is a real thing.
Mhm.
People would be forced to sell assets just to cover the tax bill because whoever's left behind owes all this to the IRS. And you only have, how long is it to pay?
So the estate tax is 9, you had to file the return within 9 months in general. I mean, you could request an extension, but it's quick.
Quick, 9 months to come up with that money that for the IRS.
And then you've got, like, let's say they're all jammed up in let's assume you have a $10 million estate and the estate tax exemption's 5 million and it's all in an IRA. Now you got to take the money out of the retirement account, which is going to be taxed. To pay the tax, it's a big circular problem. So, with the estate tax exemption being higher, that's important. And the other thing to consider, and I know it's not necessarily this group of your audience, but they very well could be their parents. I just got referred to someone where they own some rental properties. Remember that two things. Remember a step up in cost basis when you inherit property, but also remember DSU. What the heck are we talking about now? Deceased spousal unused exemption. So if your spouse passes away, and let's say I'm worth 3 million, my spouse is worth 3 million, and my spouse passes away, I don't know what's going to happen with the state tax. I actually think that exemption will go down in the future, even though it's because unless you're in Florida or hanging chads, dead people don't vote, right? So who knows? But the thing is, let's say my spouse is worth 3 million and she passes away, I can elect to take that 12 million of unused estate tax exemption and keep it. So even if it goes down to, 2 million, I've got that 12 million from her. So my point is, if you're listening and you're probably a parent or someone that if they were married and their spouse passed away recently, really talk to their tax professional about that DSU, the estate tax exemption. But not necessarily. Now this does apply to business owners too, because, and this is a tricky part too, Matt, a business owner, their biggest asset might be their business. And if they pass away, their business might be worth $8 million. They don't have $8 million worth of cash. And the government,
Yeah.
so they could get what's called a valuation discount since they're not running it. But the government's going to say, hey, that's worth 8 million. And now they got to liquidate the business. And that's where having proper risk management and as far as life insurance is as an estate planning tool, I mean, a business transition tool could be a very good thing.
Other people's money, tax free. Death benefits, tax free. It's other people's money. The IRS is telling you to do this. They give us so many ways to minimize what we pay them. And then people say dumb things like, I don't like life insurance. Well, I don't like paying the IRS more than I need to,
Exactly.
more than I don't like life insurance.
But using it properly between multi-generational businesses or between business owners is huge because you can get steps up in basis on the assets. You can get tax-free income, with the proceeds. A few more things so remember, tax laws are written to encourage and discourage certain behavior, and a lot of times tax laws are written to get votes, right? And so there's 4 new temporary deductions that are around for the next 4 years. Maybe they'll get extended, maybe they won't. We'll see what happens. But if you look into these deductions, they could affect business owners, absolutely. And they definitely affect business owners that have employees. The first one is no tax on tips, right? Well, that means that up to $25,000 of your tip income could be non-deduct or big old but there's a phase out. So that's kind of the hidden secret is all these temporary deductions, which are reported on a Schedule 1A, we anticipate about 30 to 35 million taxpayers are going to um, uh, file this, are phased out based on income. So no tax on tips is a real thing. It can help, but it can be phased out. No tax on. So who did that help out? Oh, all the service industry people. That's a big chunk of people voting. No tax on overtime. Could really help out people in the Rust Belt, especially, right?
Yes.
But there's a phase out based on income. There's a new senior deduction, or I call mature age deduction, 65 and older. When we went through the election of 24, it was like, hey, both parties were like, hey, we're not going to tax Social Security. Well, you can't do that. That's a whole different fund. So they created this new senior deduction up to $6,000 for each senior. And then, our buddies in Detroit needed a bone thrown at them. So no tax on car loan interest is another deduction. So if you have a new vehicle, that loan interest, a portion of it could be deductible. But those four deductions are going to affect a lot of people, but they're not automatic. They're phased out based on your income. And that's why we like to plan.
Phased out means if above a certain income, the amount that you can deduct goes down to eventually zero.
Absolutely. And so that's why if someone tax brackets lie to you, then my biggest message for business owners is your tax bracket lies to you. Marginal tax rate is your number one KPI. For instance, let's say you're a business owner that your spouse, excuse me, your spouse,
Hey, Chris, hold on one second. I'm going to pause right there. We're talking about tax bracket lies to you. I got to round. Give me 2 minutes.
no problem.
Sorry, I forgot to
No worries.
put the snacks in my daughter's backpack, so she ate the moldy yesterday's snacks, and my wife wants to kill me. So that was fun. Okay.
No worries, man. No worries. We'll bounce it back.
All right, so we're talking about your tax bracket lies to you.
Yes.
So I don't know where you're going with that, but
That's right. So yeah, so your tax bracket absolutely lies to you. What's the most important is your marginal tax rate. So to give you an example, let's say you're a business owner, you're at a good income level, but your spouse happens to is a server, and that then because of your income, that now the no tax on tips deduction, which maxes at $25,000, is phased out of.
yeah,
So that's where reducing your adjusted gross income. Now, we're not saying go blow a bunch of money for nothing, but maybe finding other deductions or legal and ethical ways to reduce your business income not only reduces that income, but also gets you out of the phase out. Again, hidden taxes are all over the place and we just don't see them.
interesting. So dual income families, a lot of people, like even hairdressers, work on tips.
Yeah.
So understanding how to mitigate all of that. This is good stuff. What else? More business stuff. So these four temporary. How long? We have 4 more years until the four temporary ones expire.
Correct. 25, 26, 27, 28. And then we're going to see what happens. Even things that we say are permanent changes, who
Yeah.
knows? They could be temporary, right? Well, we have to
Yeah.
look
So
at.
when you say the estate tax went up permanently, it could change again. It's just not set to at this.
Correct. Correct. So for business owners, obviously we still have to deal with self-employment tax. However, the tax brackets, which I already said lied to you, the tax brackets are much more generous. The meaning you don't bounce into those higher tax thresholds until your income goes up even more. So that's really where you want to manage your situation and really have that attitude that you're either picking your tax or the government is. And you've got, now that being said, there's no magic wand that gets rid of tax, right? As you've mentioned, you need to be prudent with your finances. You need to be able to deploy money into tax mitigation strategies or tax advantage investments or reinvest in your business to get that benefit. It's not that just a free for all. And so managing your liquidity is super important when it comes to these type of decisions and figuring out where you're at. Just like I mentioned in the very beginning of the episode, is if you're going to be exiting, are you eligible for the 1202, the qualified small business stock?
Anybody listening who is going to exit, who wants to exit in the next 5 to 10 years, needs to get in touch with you to figure out how to avoid tax on anything up to $10 million in that business sale.
Right, and if you don't qualify for that, there's other strategies too. The only another strategy, maybe a good way to tie it together, is potentially income shifting for businesses legally and ethically. And that could be between related entities. That might be creating a new entity or buying real estate, or within family members. That could be spousal. Doesn't always work out. That could be kids. So it just depends. And in the ultimately a lot of tax planning is this: taking deductions that you're going to incur those expenses anyway and figuring out how to make them tax deductible. So let's say I'll leave it with one real case study. It was a medical professional who was with a big medical practice. This person went off on their own, and this his spouse was handling a lot of the paperwork, like the billing, all the stuff that was and they had a special needs child. They were spending $40,000 to $50,000 a year on medical expenses, getting almost no deduction for it because they had itemized their deductions. It just didn't really help them. And we thought, is your wife working on the business? Yes. Let's pay her a reasonable salary, which is very small because she was doing it, some administrative work. And let's implement what's called a Section 105 plan. So even though all these, he may have not, like, he was not getting a deduction for these medical expenses. Let's do a Section 105 plan, which is a medical reimbursement arrangement or health reimbursement arrangement. And let's reimburse your employee, your wife's your only employee, for all of your medical expenses that you're going to pay anyway. And we took it varied each year, but $40,000 to $50,000 off of Schedule C at about a 37% marginal tax rate with SE tax. Those are just little things you can do. Those are what we call behavioral tax planning implementations. And now, if he had 5 other employees, it wouldn't work because we're not going to pay the medical expenses for 5 other families. So you've got to diagnose a situation and prescribe it. And that's what we teach
I
and
love
teach
it,
you.
man. You guys help business owners like crazy. So before you go, if you were to categorize maybe the biggest mistake that you see typical business owners, sole proprietors, LLCs, S corps,
Yep.
the majority of the businesses out there, what do you think the biggest mistake that you guys run into?
Well,
What do
that's
you think?
easy. They think that the money in their bank account is their taxable income. Completely different concepts, right? Tax flow versus cash flow, one of our 3 laws.
Explain that. What do you mean by that? They think the money in the bank is theirs or is their income. What is it?
Right. So let's say you own a business and you in at the end of the year you have $40,000 in your business bank account. Most business owners think, "Oh, I'm going to pay tax on that 40 grand." It's not the case. It depends, right? Or, "Oh, I'm going to keep my money in my business account so I don't have to pay tax on it." That doesn't work that way.
I get that all the time.
Yeah. It doesn't work that way. They could have a loss, right? What if they started the year with 100,000 and or what if they took money out of the business and, you know, blew it on stuff that is not a deduction? So there's not a direct correlation between the amount of money in your business and your taxable income. You can control your taxable income. That's the biggest misconception.
Interesting. What do you think the biggest, so that's an understanding issue. What do you think
Mhm.
a money move that they make that you don't see them benefiting from as much as they think that they are? Like if somebody comes to you and goes, "Hey, I'm doing XYZ," and you're like, "It might not be the best." Is there a scenario there where
Oh,
you see that?
easy. Buying a new vehicle they don't need. Buying a
That
hundred
and
thousand
that's
dollar
the
vehicle
wagon.
that they're good. Yeah, buying the G Wagon, like, great if you need a vehicle and if you want it, go for it. But don't use the tax thing as a reason that to get it, right? You buy a vehicle for 100 grand, even if you're in a let's say you reduce your tax by $35,000. You roll it off the lot and a month or 2 later, it's depreciated significantly. And you're still gonna so that's just the biggest misconception. I'm not saying don't buy a business vehicle and or anything like that. Farmers are a little different, right? Because they're tractors. And we have a bunch of content on our Teaching Tax Flow YouTube channel, and some of it ticks people off because I explain how buying a vehicle is not a tax. It's not a tax planning implementation. It doesn't fit into one of my buckets. A farmer, at least if they're buying equipment, they're actually using it to produce income. I don't know how you use your G Wagon to produce income. Maybe you're driving around. I don't know. I could even make an argument that a boat could produce income if you live in Fort Lauderdale and you're a high end realtor because you could at least float your clients around.
Yeah. I like that idea. Let's talk about that offline. How do I buy $100,000 wakeboard boat and be able to deduct that for business? Maybe I'll charge you for lessons, and now I have a business for that.
Get your captain's license or something. So
Yeah.
yeah, you have to have a profit motive. What I've found is a lot of times with business owners, the final thing is I read this book. I listen to books. I don't really read that well. Called Who Not How. It's one of my favorites. Many business owners can't get out of their own way and don't. It's hard as a business owner to trust other people, but you've got to stick to what you're doing and find the who's in your life to get you to where you want to be. It has nothing to do with taxes, but it kind of does, right? You need guys like you, guys like me, people, what we call building your personal board of directors.
Right.
And that's important.
Specialists. I was talking with a client this morning and they go, well, help me understand what you do. I said, look, what you need is more than just me. I'm doing a pie slice. I do a little pie slice of what you need. We need to get a number of people on the team here so that, and then have them all in cahoots. Like you tell me, do you want them all in on the same page with your strategy, or do you want to teach individual entities or professionals what the strategy is, then try to have them get along? Or are you going to have one person that's a jack of all trade to tell you everything? I go, I'm just not a fan of those latter two scenarios. I think you can build a team from the same page from the beginning.
I'll let
So
me
yeah,
leave with this one. Yeah. So one more time, I'm just thinking about business owners, right? Business owners have to understand this. Tax planning is different than tax preparation. And it's complementary.
100%, Chris. I'm going to put that at the beginning of the podcast. I could not agree with you more. So many people go, I got to go talk to my CPA. It's like, well, what is your CPA? Your CPA got you in this crap position in the first place.
Mhm.
So you're going to go back to have them tell you that they did it wrong? They're not going to tell you that. They're not going to
Right.
confirm what you're learning is correct. They're going to affirm the poor decision that they've already made.
Right. And we've got to have numbers, and numbers start helping us make those decisions. So you've got to, it's like if you're helping someone out, in architecting their cash flow and looking at their what you're trying to do with them, and they're like, well, how much money do you make? I don't know. Okay, how much is your house worth? I don't know. Okay, well, I can't help you now. I can't. Yeah. So yeah.
I love it. Well, dude, I appreciate all the work that you do. I think you do a great thing. I don't know
Thank you.
anybody who volunteers extra money to the IRS, and a lot of people are unnecessarily volunteering money to the IRS just because they don't know. So it's out of ignorance. So check out Chris's YouTube channel. We'll have links below if you're watching this on YouTube, Spotify, all of the major stuff. Links below to get in touch with Chris. Join his YouTube channel. Make sure you subscribe. And if you haven't yet, subscribe to Cashflow Conversations, where we interview entrepreneurs. Chris, thanks so much for being here, bro.
My pleasure, and have an awesome rest of the day.
All right. Keep crushing.
Thanks. Peace.